Hello, I am Jackie Vaughn, and I am a realtor, and I help people build wealth, long-term wealth through real estate.
And I'm Katie Zackerly. I'm a mortgage advisor, and I help you utilize your assets, large or small, to get into the home that you need.
So we are so glad you guys are joining us for our web series. Today, one of the questions I receive a lot from people is, what do lenders look at to pre-approve me to purchase a home?
That's a really good question.
Yeah.
So what do you tell them, Jackie?
Well, I typically say there's 4 things: income, debt to income ratio, credit score, and assets. How am I doing there?
That's a good list.
Okay.
I'd say that's pretty comprehensive.
Okay.
So I guess we should break it down.
Yes, let's talk about income because it needs to be documented.
Oh yes. I'm sorry. If you get paid under the table, if you don't pay the IRS, we can't count your money. And I would say income gets kind of derived into a couple of different categories. If you're self-employed, if you work for someone else, like a W-2 employee, or if you receive government-based income, Social Security, or other such thing, or if you don't have a regular income, I can still potentially create an income for you. So if you're self-employed, we need your tax returns. But self-employed, we need 2 years to average that and create an income for you. And we'll have to do another web series about self-employed borrowers.
It's a whole nother animal.
It is.
And possible, just, requires a little bit more creative ways.
Well, you just have to know what you can write off and what you can't, I guess. And then if you're a W-2 employee or other such, we need 30 days of pay stubs. And the same sort of thing applies if you're receiving any sort of government payment. We need an award letter to tell us how much to expect, and your 1099s for the past 2 years. So I think that about covers income.
Okay. So then that takes us to debt to income ratio.
Sure. And debt to income ratio is a funny word. A lot of people don't know what it is. But that's really just the number that we derive by taking your monthly debts. So I'm talking things that show up on your credit report, like your auto loan, your credit card bill, your student loan, not your child's preschool payment or your utility bills or anything like that. And then we take that monthly payment, the minimum due, and we divide that by your monthly income. And we end up with a number, hopefully, that is 45% or lower. For most first-time buyer programs like the HDA, we want to see that your DTI, as we call it, is 45% or less. But other programs like FHA might let you go up to 50%. Conventional sometimes will let you do that. And then VA doesn't really have a set or defined limit. It just they look at the whole picture and see what makes sense for our veterans.
I didn't know that. So that's a really great advantage of VA versus VHDA, which are both 100% financing loans. All right, so then that takes us to credit score.
Oh yes, everyone is afraid to talk to me about their credit scores, and you shouldn't be ashamed. There are lots of different options out there for you, and I would say the vast majority of programs start at 620. But if you don't have a 620, that doesn't mean you're not eligible for a loan. First, like VHDA requires that 620 minimum, and then different levels of their program require different scores or higher scores. But as long as your score is 580 or above, you could potentially qualify for FHA with 3.5% down. Now, once you cross over 580 and you're into 579, anything down to a credit score of 500 is going to require that you put 10% down.
That's really well said, and a perfect segue to our next category, which is assets, because you need to have cash assets to be able to put money down for those loans.
And even if you're taking advantage of a 100% financing situation, we as mortgage lenders and the loan providers want to make sure that we're putting you into a good space and that we're not putting you into a situation that'll hurt you long term. So we generally would like to see that you have some cash in the bank or in a 401k. I good safe number to think about is about 1% of your purchase price, but that's not a hard and fast rule except in certain loan programs. But I think that about covers the basics of a pre-approval.
Right, because we don't want you to be cash poor. So, well said. Make sure you check out our other video in which we get a little bit more in depth about the cost of buying a home, because there's also the cost of, you know, paying for a home inspection and things like that. So,
Yeah.
thank you for joining us, guys. We'll see you next week.
Yep. We can't wait to be there for you. And don't forget to reach out if you've got questions.
All right, bye.
Bye.